We are now kicking off our topic dealing with the accounting cycle, and we'll start by focusing on activities that occur during the period. A lot of this unit is going to be review for you, and that is by design. But before we get into journal entries and posting and all those mechanics, we need to nail down the foundation that everything else sits on. So today we are going back to basics, the accounting equation. I know, you have seen this in your intro class, but we are going to build it up piece by piece because every transaction you ever record in this course is going to flow through this framework. On the left-hand side, we express a company's total assets as a function of two components. Go ahead, say them out loud in front of your device with me. Assets equals liabilities plus equity. Assets are what the company owns or controls, things that will bring economic benefit in the future. Liabilities are what the company owes, and equity is what's left over for the owners after the company satisfies its obligations. It is so simple, but it does such an excellent job of framing several different concepts. It frames the question, how have you financed the assets of your business? To what extent are you leveraging debt financing versus owner's equity? Or maybe equity is your focus. After deducting creditors' claims to the company's assets, what is the residual book value of the company? This also lays the foundation for double entry bookkeeping. Companies engage in business transactions, and every single transaction, whether it relates to either an external or internal event, has a dual effect on the accounting equation. It produces some sort of increase and decrease to an account on any side of this equation. And we know that the equation always balances. Now let's zoom in on the equity side and keep breaking down this concept. First, I want to introduce you to the idea that many terms in accounting can be expressed with several different synonyms. For instance, I imagine that you're already well aware that equity can be called shareholder or stockholder or owner's equity. But even beyond those terms, a company's equity can also be referred to as the company's book value. Another expression is the company's net assets, which certainly refers to total assets minus total liabilities. After all the company's obligations are settled, what is the residual interest that we can give back to the owners? Those are those net assets. Now, equity is not just one big bucket. For now, we will split it into two pieces. Paid-in capital, which is the money owners put into the business directly, usually by buying stock. And we've got retained earnings, which is the profit the company has earned and kept inside the business instead of paying it back out. So equity, we can say, equals paid-in capital plus retained earnings. Let's zoom out to see this within the context of the bigger picture. A company's assets are financed with liabilities, or capital that owners have paid in initially into the company, plus all the earnings or profits that they have allowed to be retained as opposed to being distributed. It's the same equation, we've just expanded the equity piece. We can also express this equation not only in terms of levels, but also changes. We are tracking what's happening during the period, so instead of treating the equation like a snapshot, we're going to add these deltas, the Greek letter for change, to every term. The change in assets equals the change in liabilities plus the change in equity, so forth. And retained earnings has its own little engine inside. It increases when the company earns net income, and it decreases when the company pays dividends. So the change in retained earnings, for now, we can simplify as net income minus dividends. We'll add one final layer for now by further breaking out net income as simply revenues minus expenses. So let's swap that in. The change in retained earnings equals revenues minus expenses minus dividends. Having disaggregated these various components of the accounting equation, it's like we're looking at three financial statements all at once. At the top here, it's like we've got a balance sheet showing how our total assets are changing as our total liabilities and shareholders' equity are changing. Then, focusing on the right-hand side, we've got the various components of the statement of changes in owner's equity. How did our paid-in capital change? What happened to retained earnings? What were our dividends? And then lastly, we've got a little income statement right here, our revenues minus expenses to show us net income for the period. This is our first exposure to the concept of financial statement articulation, or in other words, seeing how the different financials interrelate. So now let's put this equation to work. Exercise 1. A company has total assets of 120 billion and total liabilities of 50 billion. So then, what is the book value of owner's equity? Pause for a second if you'd like to try it. Are you ready? Equity is just assets minus liabilities. So 120 billion minus 50 gives us $70 billion. Well, that's easy enough when we're working with the snapshot version of the most basic accounting equation. So now let's level up with exercise 2. During a company's most recent fiscal year, we've got 3 data points here, total liabilities increased by 17 billion. Paid-in capital increased by 10, and total assets increased by 46 billion. With all this language about increases, we're definitely working with the deltas or changes in these accounts over time. So if the beginning balance for retained earnings was $82 billion, can we calculate its ending balance? So one more time, I invite you now to certainly pause the video and try working through this one before seeing the answer. Let's plug everything we know into the change equation. The change in assets, 46 billion, has to equal the change in liabilities, an increase in 17 billion, plus a change in paid-in capital, 10 billion, plus a change in retained earnings. You could try to solve that change for retained earnings in one single step, but I like working through it one step at a time. Let's look at that top line, where I can see that if my total assets changed by increasing by 46 billion and total liabilities increased by 17, I can just do that subtraction and find that my total owner's equity must have increased by 29 billion. We can then move down a level and say, of that $29 million increase, 10 billion was due to paid-in capital plus 19 billion from retained earnings. And the whole equation balances. So now, with this foundation locked in, we are now ready to start analyzing and recording transactions.